Hello and welcome to episode 337 of the Money to the Masses podcast with your resident expert, as always, Damien Fay and me, Andy Leaks. Damien, how are you doing?
I'm good. I'm excited this week, Andy. Buzzing, because in last week's show, right at the very start, we asked you to send in your reviews because we hadn't had any reviews, surprisingly, for quite some time on the podcast, and you delivered. And Andy, in a second, is going to read those out, but he's going to read, I think, 3 of them. Is that right, Andy? You're going to read the first 3 that came in. Everybody who sent in a review this week will get their Money to the Masses mug, and we will read some of the others out on a future show. But please do keep sending the reviews in. They're incredibly motivating. I did have somebody write in and ask me, how do you leave a review? But if you go onto the app of choice that you have, so if you're using the podcast app via Apple, such as on an iPhone, you can go and find our show, and in there you can just click to leave a review. So it is pretty straightforward, so do give it a go. Some of you did leave positive feedback on the website articles relating to the actual show itself. So there were 2 people who did that, some fantastic feedback on there. So that is very much appreciated as well. So Andy, if you want to go through a couple of the reviews.
Yeah, let's start with a British Canadian who said, "This show is one of the very few personal finance podcasts that I'll listen to every week without fail. The hosts are great and the advice they give has set me on track to be able to be financially independent many years before I'd expected to be able to. Thank you very much." The next one is from Kind at Heart, a frank, honest and interesting financial show that provides current, relevant financial information in a way anyone can understand. And moving on to the final one we'll do for this week, as you say, we've got more than that, and thank you again for it. This one's Tom R23, who said, "It's a great listen, very informative, and being a young person, I believe this podcast will aid my financial success in the future." In a way, that one's one of the ones I'm most proud of, because it's kind of bringing the next generation through. I like it. Us oldies can still do it.
We can still do it. We've still got it. We're down with the kids. So thank you for sending in those reviews. Please keep them coming. They help with the podcast pushing up the charts. And also, it's incredibly motivating for the team. So I do share the feedback with the other members of the team because they will be on the show on regular intervals. Actually, I will mention that I won't be on the show again next week. We're going to have another team takeover, which, although it was the first ever one only a few weeks ago, I'm moving house next week, so I'm not going to be around at all. I'm going to be lost in boxes and chaos, so the team are going to take over for next week, but I will be back as usual the week after that.
It's going to be a weird sort of position for you, because you'll be listening to the podcast for the first time, having not been on it, probably while unpacking the boxes, putting the plates away in the kitchen or something.
Yeah, more than likely, Andy, and probably cursing the house that I bought as it falls down around my ears. One other thing before we carry on with the show, did you notice the music? Regular listeners should have noticed that the theme music changed on the podcast. It's a work in progress, but we've had somebody who has written a couple of tracks for us, and this is one of them that we're probably going to use going forward on the podcast. Tell us what you think about it. And the reason we had to do that is because when we share our podcast on socials, despite the original track being free to use and everything like that, it did start to limit its usage because we didn't own the copyright. So why not, being a podcast, one of the biggest and best podcasts in the UK that deals with money, and we've been around about 6 years now, I think it's about time we had our own music. So hopefully you like it.
Great. So that sort of moves us on then to what's coming up in this week's show. So Damien, what have we got?
So I'm going to do a piece on investing. This is a piece that's going to go through 80/20 Investor. Now, I've been doing 80/20 Investor for, I think it's 6, nearly 7 years now. And I run my own investment portfolio and do lots of different pieces of research, the unique stuff that I come up with. And I'm going to go through some of those pieces in a bit of a roundup, my favourite takeaways. So that is something that's basically giving podcast listeners free access behind the curtain to be able to see what we do on 80/20 Investor. So I'm going to go through a load of those. It'll be incredibly insightful. I'm then going to talk about furnished holiday lets. So there's a move from people who are buy-to-let landlords moving into holiday lets because of the tax benefits of doing so. There's been a big shift. So I'm going to look at what's going on and whether it's worth doing it. And finally, I'm going to talk about whether it's worth borrowing more money, additional money, when you remortgage.
Okay, so let's start with the main piece of the podcast then. And we're going to be talking about investing and going back over some of your biggest hits, if you like, looking at the research pieces that you've done and the ones you're particularly proud of.
Yeah, I'm smiling at you, Andy, because it sounds like somebody who, when artists release their greatest hits album, it normally means the career's either ending or they're changing labels. It's not actually normally a positive, but this is kind of a greatest hits of 80/20 Investor. So what happens is I release a couple of pieces of research every month on 80/20 Investor, along with all the other stuff that's on there, such as fund shortlists, weekly newsletters, monthly newsletters, etc. And you can sign up for a free trial if you want to see more what's going on there. And basically I teach people how to invest their own money. And it comes from a career of doing that in the city for wealthy clients. And I'm going to run through, I originally thought what I'll do is I'll pick, say, my top 5 favourite pieces of research. And as I started to write the list, I got to like 20 titles that I've done. So what I'm going to do is I'm going to read them out. And Andy, I'm going to let you pick 5 of them, and I'm going to give people the insights that came from that piece of research. So one of the early ones I did was called the Annual Chinese Equity Rally, which looked at a phenomenon that exists in Chinese equities. Probably my favourite piece of research I ever did was the Perfect ISA portfolio, which was one about where I designed a portfolio looking at history. And I did this back, I think it was 2015, for a portfolio. Could we make one that had never lost money in a given tax year since the year 2000, had a static asset allocation, and had outperformed the FTSE 100 since the inception of ISAs? Now, what was great about that piece of research was that I did it in 2015, and yet the findings have been proven to still hold true for the next 5 years. So every year that portfolio has still achieved those feats ever since. The winter portfolio was one of my favourites, where that was looking at portfolios that outperform in the winter. There's a definite phenomenon there. Funds buy cheap, buy twice. Where I was looking at whether you should invest in cheap funds. Does it actually improve your investment returns? Should you ever invest in gold? If so, how much? The best strategy in the stock market: crash, stick or twist. That was a very popular piece. How to make your portfolio immune to stock market volatility. We touched upon that in actually podcast 57, because some of these pieces did feature in past podcast shows. So where that's happened, I'll try and dig them out and link to them in the show notes of this particular podcast. How many funds should you have in any given sector? So if you're investing in UK equities, how many funds should you have before you actually start diluting the benefits of diversification? What's the most profitable day of the year to start investing, which was an unusual one? Best way to invest cash, is it to drip in or do you go in all at once? What's the highest charge you should pay for an investment fund? Do active funds outperform passives in sideways or falling markets? We touched upon that one in podcast 229, so go back and listen to that one. Is manager performance down to luck? So fund managers are active. Is it down to luck when they outperform? How often should you rebalance your portfolio? Should you follow star fund managers? Are funds with performance fees worth it? Another piece I did was how often should you check the value of your portfolio? I'm up to number 18 at this point. I was only meant to be picking 5. Sectors where active funds beat passive funds. How often should you change your funds in a portfolio? Does a new all-time high make a market crash more likely? What are the best all-weather portfolios? I analysed that, and I did give some findings in episode 278 of the podcast. So all-weather portfolios are those that are supposedly meant to do well regardless of what's going on in the sort of macroeconomic backdrop and investment markets. An investment piece on how to navigate market tops and bottoms. So it's some indicators to look at. And the summer portfolio combined with the sell in May and go away adage. Now, there's a whole host of others I could have put on that list, such as funds for stagflation, funds for Brexit, funds for the UK general election. I just picked a short list, which was quite long. So, Andy, what I'm going to get you to do is pick 5 of those. So I will give the listeners the insights from those pieces of research. But what it does, it lifts the curtain to tell people, look, if they want to know more about investing, then they can find out on 80/20.
Okay, well, you've kindly kept the page open with all the big hitters there, so I'm literally going to run my finger down. Winter portfolio, what's that one about?
So we did a piece on this in podcast 297, actually. So that is regarding the phenomena of UK stocks outperforming over the winter period versus the summer. So if you look at the winter period between November to the end of April, UK stocks tend to do better during that period than they do during those summer months, so the other months. And the research looked at what would happen if you simply bought equities during those winter periods and then went into cash during the summer and kept repeating that process. Now go back and listen to episode 297 when I go into more detail about what happens if you use trackers, etc., and the numerical results. But the overall gist of it is that you can capture pretty much all of the upside in equity markets if you use a winter portfolio strategy invested during November to April and then in cash during the summer. And that is based on looking at history, going back over time. Now, there are periods where it didn't work. And what is particularly interesting that you've picked this one is that, like I said, episode 297 was done around November 2020. So I looked at this piece of research on 80/20, did a piece on the podcast where I mentioned about this phenomenon existed. But the year before, in 2019, the winter portfolio strategy did badly. And it's because of the pandemic came along and wrecked everything. Because you remember in the February of 2020, markets started to tail off and they collapsed in March. So it didn't matter what you bought, you were going to lose money in equity markets because they crashed, didn't they? And I said at the time in November 2020, I said, this year should, if you go back and listen to it, hopefully be positive for this strategy because we've just had a vaccine. The vaccine had been announced about a week or two before that. And it's interesting because I was proved right, which is always nice because sometimes you're not proved right. And one of the other things the research has shown, if you want to use this strategy, you are better picking an active fund in the UK mid-cap universe. So pick a UK smaller companies fund, an actively managed one, because it's one of those instances which goes back and links nicely to another piece of research about the sectors that outperform when it comes to active managers versus passive strategies. Active managers in that universe, UK smaller companies, tend to outperform passive trackers. And so what happened is I actually mentioned a fund in there. It's rare that I would do that, but I mentioned a fund was the Fidelity UK Smaller Companies Fund and said that one had been a strong candidate, wasn't a recommendation. So I went back and looked at what happened from November 2020 to the end of April this year. Now the FTSE 100 was up 27.19%, so it was a nice rally, UK equity, so that it proved again. The FTSE 250, that kind of mid-cap space, was up 31.95%. That's 6 months. Now the summer period this year, if you look at the summer period, the FTSE 100 has just gone sideways. But that winter period, we had basically 32% on the FTSE 250. That is an epic return, given that the market had already rebounded from those lows in the pandemic by the time we got to November 2020. The actively run fund, so the UK Smaller Companies Unit Trust sector, actually made 40.67% during the period November 2020 to the end of April 2021. But the Fidelity UK Smaller Companies Fund made 51.56%. That's a huge amount of money during that period of time. And actually, it was the 6th highest return from any UK smaller companies fund out of 46 within that sector. And some of the lowest ones produced about 17%. So it's being in the right fund that matters. So I'd like to think this podcast has probably made some people quite a bit of money over that period of time. I had that fund in my own 50k portfolio, for example, in 80/20 Investor, and I still hold it at this particular moment in time. That's not a recommendation. I'm just telling you what's going on in my portfolio at the moment. So it just shows you the winter portfolio strategy work that came from that piece of research. I nailed my colours to the mast based upon that and gave a tidbit to the podcast listeners. And if they decided to invest, they would have made over 50% in that 6-month period. So maybe if you have made some money out of that, you might donate a bit to charity if you wanted to. But it's up to you. Just keep it, spend it, do what you like. So that was a really good one where you look at something, you apply it, and the future comes along and it could go horribly wrong, but it turns out it actually almost proves the research and the strength of it.
Okay, good. So let's pick another one then. We're going to run through 5, aren't we? Let me just have a look. I'm going to pick this one. So what's the highest charge you should pay for a fund?
So I'm talking about the AMC of a fund, so the annual management charge. And I did a piece of research where I looked at the performance over a period of time. So it was a 5-year period of time of a fund and versus the cost of the fund. So we looked at, that would include sort of passives and actively managed funds. And you can look at the research in full if you wish, if you sign up to 80/20 Investor. But what I did by plotting the performance of a fund over that period of time, that 5-year period of time, and then looking at the cost of that fund, you could produce almost like a scatter chart, like lots of darts on a chart.
One of my favourite charts, a scatter chart. I like that. Sounds bizarre, but I know genuinely. I try and find the pattern in the, in the
Do you know what, Andy? I've got a maths degree and I've never had a favourite chart. So you surprise me. I'm always learning things about you, Andy. You have a favourite chart. So I drew the line of best fit, which will send Andy into fits of ecstasy. And the conclusion that came from this is if you simply buy funds because they're cheap, it won't maximise your investment returns. And cutting costs doesn't guarantee improved returns. It's not a perfect correlation, but costs do impact performance over time. So I produced a table where I looked at funds that had a 1.5% charge and just used a 7% growth rate on £50,000. If you go to the extreme end, after 30 years, you'd have 242,000 basically if you'd invested in a fund with a 1.5% annual management charge. If you'd invested in a fund with a 1% annual charge, then you'd had 281,000, almost £282,000. So the difference was borderline £39,000 difference just by being in a fund if you got the same return, assuming, but the charge was just that bit lower. Now, what the conclusion actually came from the research when you looked at the numbers, and I produced these scatter charts over different lengths of time. If you invest for 5 years, so that's the minimum term you should really invest for, then if you invest in the fund with a charge up to about 1.5%, then it shouldn't have a huge impact on your returns compared to investing in something that was cheaper because it hasn't had enough time to compound. And the differentials in individual funds' performance is likely to be the biggest determining factor about your returns. But if you start heading above 1.6% per annum, then even over a 5-year period, it starts to hit your returns on your portfolio. So the takeaway there is 1.5% is really the top end you want to be paying for funds on an investment portfolio. And I'm ignoring platform fees here because I just looked at the underlying fund performance, because the platform fees will be the same regardless of what fund you actually invest in. So don't aim to pay any more than 1.5% if you're investing over 5 years. If you go for 10 years or more, then it really starts to have an impact. And actually, you need to aim for not paying more than 1% per annum for a fund. So that becomes the sweet spot there. But ultimately, cost matters, but it's still the underlying fund and investment choice. That is key.
Okay, moving on then. Let's go for sectors where active funds beat passives.
Okay, I did a bit on podcast 229 that talked about this, but I didn't give away the sort of one of the golden nuggets on it.
And you're going to do that now?
I'm going to give you a golden nugget on this one. Now, I looked at different sectors. So imagine different asset classes, so UK smaller companies, global funds, and looked at how actively run funds, so those with fund managers, which tend to be a bit more expensive compared to the cheaper alternatives of passive investments. So things like ETFs that just track indices. So I'm going to run through the sectors now. Some of the key ones that we did. So Asian Pacific, excluding Japan. Now, active funds within that sector underperformed on a relative basis compared to passive investments by a total of about 1.28%. Now, Chinese equities, they massively outperformed. I'm talking about the active funds here. They made more than 20% more because they were active funds compared to passives. European equities, that's another good space. Europe excluding UK, unit trusts, that sector, the active funds tend to outperform by about 13 to 14% over a 20-year period. Global funds, now this is the area where active management seems to fall down. They tended to lag about 10 to 11% over a 20-year period. Global emerging markets, again, it was down around about 11%. That's active versus passive. So stick to passives if you're investing in global versus global emerging markets is the sort of general trend. Of course, there will be individual funds that massively outperform. What I'm doing when I'm looking at the average of these actively managed funds compared to the passives. Japanese equities, actives marginally underperformed, again, passives. North American equities, this is quite a famous example actually, that North American equities, fund managers struggle to beat the S&P 500. And over a 20-year period, it was almost 12% less that they'd made. So that's significant. Now, UK all companies, so that's the equivalent of the FTSE All Share, is the passive index. Then active managers outperformed by nearly 4% over the 20-year period. So not a huge amount. But UK smaller companies is where the magic happens. And over a 20-year period, these actively managed funds outperform the small cap index by 100%. So that's basically making twice the money. And if you go back to the first bit that you asked me about the winter portfolio, you could see that in the numbers almost there. They were almost heading towards being double. So the takeaway was the golden nugget that I didn't tell you last time was that UK smaller companies funds are where the active managers really outperform and do really well. So that links quite nicely to the winter portfolio piece. So when you get all these different bits of research, you actually start to find over time that one of them leads on and actually confirms something you thought or discovered in another piece of research.
Great. So number 4 then, let's go for this one a bit further down. Is it worth rebalancing your portfolio, and how often should you do it?
Okay, for this one, I looked at the data for a whole bunch of asset classes over 27 years. So that was how long the data would go back. And I built a portfolio that just assumed that the people had invested in an equal amount in each of these 17 different asset classes. So those asset classes included global funds, mixed funds, so the multi-asset funds, North American funds, equities that is, property funds, corporate bond funds, UK equities, small caps, Chinese equities, the whole lot. And when we looked at the impact of rebalancing the portfolio over that extended period of time, so you imagine every year, every quarter or every month you rebalanced, or you didn't rebalance at all, you came up with a total return figure. And that was actually going from 1991, which is the start of the data, to that point when I originally did the research was in the middle of 2018, hence the 27 years I mentioned earlier. The portfolio that performed the best was the one where you didn't rebalance. The number 2 was when you rebalanced annually. When you rebalance quarterly, it was 3rd. And when you rebalance monthly, it was 4th.
Basically, so the more you tinker with it, the more you mess it up.
Well, that was kind of what it hinted at. But I did take it a step further. But if you just dwell on that for a second, it kind of makes sense. So what happens, you're riding a version of momentum, aren't you? So as things start to accelerate away, say like you had some UK smaller companies exposure, like I mentioned earlier on, let's imagine that was just one part of your portfolio. So it was only probably about 3 or 4% of your portfolio to start with. But as over time that started to race away, by the time you got to the end of that 27-year period, you'll probably find that that fund of that asset class was making up probably more than 10% of your portfolio, because the ones that had underperformed had shrunk in value, but that one started to dominate. That's what happens. And so your risk level increases. Does that make sense? Over time when you're not rebalancing? So you're kind of just going wild. It's just being allowed to run. And over time, equity markets tend to rise. That's just a given over the long term.
Yeah, I've never thought about it like that. It's almost like an evolution of your portfolio, that it's moving towards the things that are performing well.
Yeah, and I mean, I actually did the numbers. And if you did no rebalancing, then by the end of the 27-year period, 26% of it would have been invested in China.
Wow.
And only 1% of it would have been in strategic bonds, where they all started out at around about 5.8 to 6% was invested in each sector that I've mentioned. So you can see you just become something that starts morphing into a quasi-Asian Chinese equity fund. So that's why it starts to pull away. But the reality is people don't invest like that. People invest by picking an asset allocation that's a much more strategic, because they want to manage risk. So let's take something like Vanguard's Life Strategy Fund, their 60% equity version. What they might do is they might put something like 32% in North American equities, about 20% in global bonds, 9% in European, excluding UK. And then you go all the way down to where Asian equities are only about 2% of the portfolio. So that is something that is much more representative of how people invest. They don't just pick a range of asset classes with varying risk levels and then just buy them all equally. So by trying to manage risk in this way, that represents a more realistic portfolio. And now, let's do the same exercise again over the same period of time. What would have happened? The one that came first was actually the one where you rebalanced annually. And the one that came second was no rebalancing, followed by 6 monthly, followed by quarterly, and then last but not least, monthly rebalancing. Now, you'll notice I said 6 monthly in that particular list. I didn't do it in the original list, but it's still, the answer is still the same. The point is that rebalancing annually is good enough and actually can boost your investment returns. Now, people may not realise they might have an advisor that says, oh, we will meet you every year. That's down to the fact they don't want to meet you every couple of months. It costs too much money. But coincidentally, they don't realise it, but revisiting a portfolio once a year can actually boost investment performance rather than just letting it grow wild. So the message to this part of the podcast is review your portfolio, but chill a bit. You don't have to be tinkering away over and over again.
Okay, then, final one. Let's have a look. This one I'm finding interesting. So the most profitable day of the year to invest. Are we going to have another nugget here?
I'm going to give you another nugget. Like all of these pieces I'm telling you, the full research that gives you more than what I'm telling you on this podcast, that you can apply it. You can find out if you go and read the actual research pieces. Now, the best day, this piece of research was a slightly fun piece, but was to see if there's any sort of pattern that occurs. If you invest on a given day, would it determine your ultimate outcome? A bit like people who try and have their children born in September because they think it will make them all Olympic athletes, according to research. I looked at the average rise in the FTSE 100 over a 5-year period, and I looked at that from the inception of the FTSE 100, which was 1983, all the way up to 2015 when I actually did this piece of research. And I found that the most profitable day, if you're going to invest for 5 years, on average, would be the 3rd of January. So bang in the new year. First day back in the new year is to put your money to work.
Yeah, that's almost literally the first working day back.
It is. Yeah. The next day was 10th of January, then the 24th of January, then the 17th of January, and then in 5th place was the 14th of Feb.
That's Valentine's Day, right?
So could you asking me? But yeah, I think it's Valentine's Day. So the point is that there was a nice skew there. You do a piece of research like this and you start to notice patterns. So if you took that one step further and actually thought, well, let's not focus just on days because the differentials can be quite small. What about months? Now, I'll give you the top 5 months.
Well, I'm going to guess January is the top month.
Well, it's not actually. Oh. It's July, oddly enough. July was the month. And the way I worked that out was that it was the month with the most best days in, basically. But you can see the strongest days. This was going beyond the top 5 I was looking at, top 5 best days. Right. But you can see January was obviously 2nd, 3rd was December, 4th was February, and 5th was March. Now, again, I just reaffirm the point that this kind of starts to point towards a bit what I said about the winter portfolio. Because look, 4 of those 5 are in that winter period that I mentioned when equity market performance was strong. So that perhaps is one of the reasons why we're seeing this pattern. The other one is because don't forget, at the start of the year, there's a feel-good factor. We see a massive surge in traffic and everything in January. Everyone's new year, new me, new money. And we also have the tax year end that happens. So people start to invest and rush to invest money before the end of the tax year. And of course, a flood of money into anything and any asset is likely to have a positive impact on prices to a certain extent. So July, why July? I don't really know why July is such a strong month, but it could be because people rush to invest just before they go away on holiday, before the summer lull. But there you go. Strong patterns in the early part of the year is when statistically you're likely to make more money if you start investing, putting money to work.
Okay, so moving on then, and we're going to be talking about buy-to-lets, but there's been a bit of a flip, isn't there, from people doing buy-to-lets traditionally now to doing holiday lets or turning them into holiday lets. So why is that?
So there was some research that was carried out by the government in the last few weeks, and it was published, and it showed that more than 11,000 second homeowners in England have flipped their properties to become furnished holiday lets since the pandemic, which is a huge shift. In fact, it's a 20% increase. So this boom in holiday lets has started to become ingrained, and it's a trend where you're seeing people now thinking, well, they may be buy-to-let landlords or wanting to get into buy-to-let, but are now pondering, is having a holiday let a better idea financially? Now, rental prices have boomed in holiday hotspots. That is one of the driving forces of why people are starting to notice and wanting to get into holiday lets, because there's been a big rise in staycationing, isn't there? So holidaying in the UK, and that again is because of the pandemic. Anybody who's tried to book any kind of getaway in the last year has probably had to almost remortgage to do so. They'll know the prices have gone up and they can make some decent money. I mean, if you look at the average 4-bed cottage, that is at the moment, as a furnished holiday let, could average around about 21 grand a year gross as an income, which is a lot of money. So you can see that buy-to-let landlords have been hit over recent years. Because you remember we've done it on the podcast, so buy-to-let landlords had some very good tax relief when it came to owning second property. So they were started getting hit by the stamp duty additional rate, so they were having to pay 3% additional stamp duty when they're buying properties. So that might have put people off buying new ones. But since April 2020, buy-to-let landlords can't deduct the finance costs from their property earnings and they only received basic rate tax relief on costs. So basically, it meant they made less money. They were paying more tax. So buy-to-let started to become less attractive. And plus, there were some changes in the laws of the Tenants' Fees Act and the government's plan to abolish Section 21 evictions, which are effective. Without going into it, there were things called no-fault evictions. It really meant that landlords financially weren't making as much money and benefiting from generous tax reliefs, and their tenants were actually getting more rights. So as an investment, it became less attractive. What was interesting is that while there would obviously been an incentive in terms of income to get into furnished holiday lets, as I mentioned, and don't forget there would have been, during the pandemic, some people weren't able to pay their own rentals, so buy-to-lets became less attractive for that reason because people weren't able to pay rent. But the tax breaks still exist on furnished holiday lets. Now, if you meet a certain criteria, which is that your furnished holiday let has to be available to the public for 210 days a year and let out for 105 of those, then holiday lets can still deduct all their mortgage interest and other finance costs from their turnover before they calculate tax. That's basically as it was for buy-to-lets. But now, holiday lets still benefit from tax incentives. So you can see now that they're looking at the environment, so the increase in demand for holiday rentals, the tax benefits as well, and the negative aspects I mentioned about buy-to-let, that they're now shifting across. So this is clearly still a problem for people who wanted to buy their own homes, first homes, because the buy-to-lets are now just shifting to furnished holiday lets. So what is the truth then? Is it really, if you're a buy-to-let landlord, a good idea to flip over and get into being a holiday let, a furnished holiday let? Now, Love Money did some quite interesting analysis on this. They ran some numbers and they looked at a couple of fictitious examples of comparing being a buy-to-let landlord with running a furnished holiday let in two locations. So they started one of them with Whitby. We'll link to the article so people can read the numbers. And they've made some assumptions in here. And so they did the buy-to-let in Whitby, which would be a 2-bedroom holiday let. So the holiday let would make 13 grand a year, which is a pretty decent sum. The rental income for a buy-to-let landlord would be 7,872. So there's a big difference there already. What is interesting is the mortgage interest, because they won't be able to get the same mortgages. There's buy-to-let mortgages and there's holiday let mortgages. So for the buy-to-let mortgage, the mortgage interest was £1,780 a year. For the holiday let, it was nearly 3,000. But there was also a big difference in the fees associated with it. Looking at nearly £1,000 for the buy-to-lets versus £3,000 for the holiday let. And of course, there's running costs as well. So you're looking at £2,600 for the holiday let, about £800 running costs for the buy-to-let. Now, of course, you paid less tax with the holiday let, £1,700 versus £2,100. Taking all of that in the round, when you looked at the profit for a buy-to-let was £2,260. The holiday let, the profit was £2,606 from those two different income figures that I mentioned. So a holiday let is definitely more profitable in this example. But given that the buy-to-let was generating just under £8,000, holiday let was generating £13,000, that differential is, we're talking about not even £400 in terms of profit. So people are overlooking, they're thinking about the tax incentive to make an investment, which is always a bad idea. There's that phrase, never let the tax tail wag the investment dog. And this is a good example of that. Again, there are assumptions in it, but they did one based in Fairfield, which is Liverpool. And again, I'm not going to go through all the numbers because you can look at the article. But for a buy-to-let, you would look at rental income of £16,716 versus a holiday let of nearly £33,000. The actual profit, after you take into account all of the tax and interest and everything like that, running costs, the profit from a buy-to-let is £6,300 versus £9,166 for a holiday let. So you can see that the profit was bigger in the Fairfield example, but given the holiday let income was twice that of the income from a buy-to-let, it isn't twice the profit you make at the end. So, and that again is because of the costs associated with it. So people do overlook that. And the other thing I want to throw out there is that you have to realize that you might be sitting there thinking, well, I'm going to turn my buy-to-let into a holiday let. There are places like London, for example, that can prohibit short lets for more than 90 days without planning permission. So you can't just do it all the time. You also would need to be the freeholder, and it's obviously got to be furnished as well. And you can't just use a buy-to-let mortgage and turn it into a holiday let, because some people think you can do, but technically you're breaching the conditions of that mortgage. So theoretically, the mortgage company could intervene if they found out. So if you took out a mortgage specifically for a holiday let, it would tend to be more expensive than that for a buy-to-let. And it's unlikely that you would get a loan to value that was much higher than 60 to 70 odd % on a mortgage for a holiday let. So you're going to have to probably pay more up front to be able to do it. So there are pros and cons, but the reality is there are quite a few cons to doing it. Plus, you've also got to rent the thing out. So that means you've got to use Airbnb or whatever you use. You might end up upsetting the neighbours and all sorts of things. So it isn't just a one-way street that a holiday lets are a guaranteed way of making more money.
I suppose one of the key things here, if I was in that lucky position, I'm someone who doesn't like stress. So the idea of the holiday let for me, because you can kind of hand it over to Airbnb to do a lot of the sort of legwork for you, the fact that you know that you haven't got to evict someone, and actually you've got a second home that you can visit yourself for free, that might be quite nice.
Yeah, Andy, I couldn't agree more, because one of the things, I'll see if I can link to it. There's a good article that I read where somebody just talked about their holiday let. And really, it boiled down to they loved their holiday let because they didn't really let it out all that much. And they found it was really a haven from life. They had a social life down there. So I'm talking about a haven from their work life and stresses. It was somewhere where they could really relax. Even though there were costs associated with it, the positive nature of it, the positive impact on their actual life and their family life was significant. So in that regard, holiday lets can have a place where if you want to make a bit of money, you can do. But if it's just literally an investment, then like you said, it's very close, and it will come down to probably whether you want the hassle or not.
Okay, so moving on to the final piece then, and we're going to be talking about remortgaging. And the key question, should you borrow more when you're remortgaging? What's the answer?
So I'm not going to dwell on this one because I'm conscious we've done a lengthy podcast, but that gives people plenty of listening to my voice for 2 weeks, really, because I'm not going to be here next week. So this is going to be quite a short, punchy answer just to give you the highlights. But it came about, this piece, because we were talking in the office and somebody was talking about, and they bought a house a couple of years ago and they're thinking about they need to do a lot of work to it, wondering if they could afford it or not, blah, blah, blah. And then I highlighted the point about the property prices. So they bought literally just before the pandemic, before the world went completely batty and house prices were jumping 10-15% in less than a year, and mortgage rates hit the floor like historic lows. Now that combination is quite attractive because it can be a good idea to look into borrowing more money. For example, if you want to improve your home and the value of your house has risen significantly from when you first took out a mortgage, and also in this environment, because mortgage rates have fallen, you could probably find that if you speak to a mortgage advisor, get advice, do it early before your fixed term comes up. Let's say you've got a fixed term for 2 years. Look into whether you can borrow more money if you need to, because you may have benefited. Your house price may have jumped 10-15% in the last 2 years, which is very likely in reality, and mortgage rates could be better. And it means you could potentially boost your borrowing power when it comes to trying to take out another mortgage. The one thing you've got to bear in mind, obviously, is your circumstances. So how have your earnings fared and your own financial circumstances in terms of other debt, etc. So that is going to come into it, because you have to do an affordability check when you remortgage and look to try and borrow more. But assuming that those things are in good stead and you've got enough income coming in so you can meet those requirements of affordability, and in some cases where they use multiples, then there is no reason why you couldn't borrow more money. Go back and listen to our podcast on green mortgages. Just search the website, you will find it, because it is possible if you're trying to do improvements to your house, then you can get a cheaper rate with green mortgages. You remember we did that a few weeks ago. And the other thing to bear in mind is to look at all types of borrowing, because it may be, if you're only trying to borrow a small amount of money, you may be able to do it over the shorter term, even with something like a loan that's unsecured, that has a very low rate, or even something like a 0% purchase credit card, where you only want to borrow a small amount of money, because over the long term, you will pay less interest. Because don't forget, if you put some borrowing onto your mortgage and you borrow more money, you're going to be paying that interest over a longer period of time, let's say 25 years, to pluck a typical term out of the air, then that starts to accrue and you'll end up paying more interest over the long term. And of course, the flip side of that, when wouldn't you want to? Well, there can be a whole range of circumstances, but typically if you're in a fixed deal that's got a high redemption penalty, so there's going to be an early redemption charge if you go and try it and remortgage, that would be a scenario where you wouldn't probably look to try and borrow more money. Or if you've already got a high loan to value, you might not be able to. So make sure you speak to a mortgage broker, because they can look at the numbers, they can tell you what's out there, and they could even give you advice in the lead up to your remortgage on how to get your finances in order to increase your chances of actually getting the deal you're after.
Okay, so that's it for this week. If you want to get in touch with Damien, you can do so in the usual way. It's Damien at moneytothemasses.com. Twitter, it's at moneytothemasses with a number 2. We're on Instagram, YouTube, TikTok, and all the usual places. Please do review the podcast if you can. I know we mentioned it already in the podcast, but it really does help us to help more people. And Damien, we're going to be signing off now. You won't be here next week. Well, we will miss you. Hopefully we'll do a good job and we'll see you in 2 weeks. And fingers crossed for a smooth move. And you'll be in a new home. How exciting.
It is exciting, Andy, but it's also incredibly nerve-wracking. And as I promised, we are going to do a bit of a moving special in terms of buying a house. Things that I've learned, and a number of us have learned in the office over the last year or so, because out of all of us in the office, more than half have actually bought a new house in the last 18 months.
That's right. So all that's left for me to say is until next time.
Until next time.
Whoa.